Welcome to the WTR On the Horizon podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. Today, we're joined by Rick Rosenthal, Director of Business Development at Cboe Global Markets. Good morning, Rick, and thank you for joining us today.
Good morning, Tim. Thanks for having me.
So, Rick, to start, can you briefly describe your role at Cboe and your focus within index options?
Sure. A little background on myself. I've been with Cboe for over 10 years and in the industry for about 45 years. As a member of Cboe's derivatives buy-side coverage team, my focus is on the wealth management segment. Essentially, I help advisors, financial advisors, understand how options-based strategies can be used for a variety of investment solutions and as fiduciaries, deliver benefits to their clients' portfolios.
Excellent. That's a critically important role. So to set the stage, when investors talk about RUT options, what are they referring to specifically, and why do these contracts matter in the small cap landscape?
Sure. So RUT is referring to, it's a ticker on the cash settled index option, which is listed exclusively at Cboe. This is the underlying is the Russell 2000 index, which is the most widely viewed index measuring the performance of U.S. small cap stocks. On Cboe, this is the third most actively traded index option, following SPX and VIX. It has an average daily volume of about 75,000 contracts. And if you look at that on a notional basis, about 16 billion per day.
Those are huge numbers. Rick, for listeners unfamiliar with the RUT options, kind of drilling down a little further, can you walk us through why the Russell 2000 options have become such a popular hedging and trading vehicle?
So there are some distinctive characteristics differentiating the Russell 2000 from its large cap counterparts. For example, the small cap stocks within the Russell 2000, the vast majority derive their revenues from domestic business activity. They're companies that carry a higher level of debt and far more sensitive to interest rate movements. Domestic policies like imposing tariffs can have a positive impact on the Russell 2000. So trading options on the Russell 2000 is a capital efficient way to gain exposure or manage risk for the small cap market segment.
Excellent. So what are the key differences from your perspective between options trading RUT and IWM, and which instruments do investors tend to prefer for different strategies?
I love this question because it gives me the opportunity to really shine the light on major differences between the two. The underlying on RUT options is the index itself. The value of this index is determined by multiplying the index times $100. So if you take the index level, which is roughly 26,800, the value of one contract is 268,000. This compares to IWM, which is essentially an ETF. So the ETF measures the performance of the Russell 2000, but it's in a much smaller notional value. So the option is 1/10 the size of the Russell 2000. Being cash settled, at settlement, you're either going to receive a credit or debit. There's no possible assignment or delivery of an underlying. It's simply a credit or debit to the account. It's a European Russell. The RUT is a European style option, which means there's no potential early assignment. The exercise of cash settled index options can only occur on the expiration, so it removes the risk of early assignments.
Noted.
And finally, being a broad-based index, it has the benefit of being a 1256 contract. A 1256 contract is determined by IRS code, and it offers a tax benefit or potential tax benefit, blending a long-term and short-term tax rate, 60% long-term, 40% short-term. So the combination of being cash settled, no delivery, European style, no early assignment risk, as well as being a 1256 contract with the blended tax rate, makes the index option preferable to many market participants.
Those are certainly key differences. So one of RUT's key features is cash settlement. For portfolio managers hedging a basket of small cap stocks, why does that matter compared to physically settled alternatives?
Yeah. So as mentioned, RUT carries a higher notional value. And as a result, hedgers don't need to use as many contracts, and it can reduce the cost for hedging. Being a 1256 contract also offers a potential tax advantage. RUT, exclusively listed on Cboe, is a hybrid market. And what that means is that we have RUT traded in an open outcry fashion, as many may view the good old days when these products were traded only in an open outcry fashion. Today we have a handful, and RUT being one of them. We have a crowd of market makers and brokers who are providing price discovery. They're providing liquidity. It's a transparent market, so it's visible. Those who want to trade in large size or small size or trade a complex order, in some cases, multiple legs, as many as 20 to 50 legs in a trade. We have market makers and brokers who can handle any kind of order. In addition to that, we have electronic markets. So those are markets that provide liquidity as well, price discovery as well, different market structure. But we have market makers on Cboe, on BZX, and C2 who are obligated to make a two-sided market under any market conditions. So depending on whether you need significant risk capital, whether the market conditions are normal or very volatile, we have a pool of liquidity dedicated to providing risk capital on our exchange.
Excellent. So as we think about who uses RUT options and common strategies, Rick, how are different types of investors utilizing RUT options at the moment?
So interestingly, Cboe has been experiencing record volume. And over the last 6 years, we've seen record volume coming from a variety of market participants. And this is a result of a bull market, elevated volatility, and strong retail engagement. The demand for short-dated options, which we refer to as zero-DTE, 0 days till expiration, has dramatically increased, and a lot of that is coming from retail participation. Today, zero-DTE trading activity is averaging about 20% or more of the total daily volume in Russell. So being a more volatile index than, let's say, the S&P 500, we're seeing a lot of interest in using the Russell for both a way to gain exposure to the U.S. small cap market segment, as well as the ability to harvest or trade volatility.
Understood. So one top of mind question I have that I think is uniquely relevant in recent weeks even is that for investors bullish on small caps but concerned about downside risk, what ways can they leverage Russell 2000 option strategies?
This is an interesting question because there are very few financial instruments that allow investors to shape the risk and reward of their investments. So using options, for example, one can purchase a put on the Russell 2000. And similar to buying insurance on a house or a car, you're paying a premium for that protection, and it can be expensive. Alternatively, there are strategies like a collar or a buffer protection strategy that allows the investor to define the level of risk exposure they want to have and also have a targeted level of upside participation. And what's interesting is there are many people who are not familiar with these different types of strategies. It's okay. It's important to understand this strategy and the benefits that can be derived by using these strategies. Whether you do it yourself or you want to find an ETF, investors have the ability to allocate to an ETF or allocate to an advisor or an investment manager who can manage these strategies on an SMA basis.
So if we pivot the conversation a bit toward relative value, positioning, and market signals, how are professional traders using Russell 2000 options to express relative value views?
Sure. So the Fed started lowering rates back in September. They lowered it 3 times, and since then we've seen the Russell 2000 go up almost 10%. And in the same time period, the S&P 500 roughly 3%. On a year-to-date basis, the Russell is up 8%. The S&P is basically unchanged. So given the backdrop of lowered rates, the imposition of tariffs, an overvalued artificial intelligence market segment, particularly the Mag 7, many investors are rotating out of the large cap names or the large cap indexes, and they're rotating into the small caps, which have been undervalued. So using RUT options is, again, a very capital efficient way to express a bullish view on the market. And it doesn't have to be just buying a call. And I noted earlier that the value of one contract is $268,000. How can there be so much retail participation in a contract that is carrying such a high value? And a lot of it is done through spreads. Mm-hmm. So retail investors are finding ways to express a bullish view buying a vertical call spread or maybe a calendar spread.
I'm going to frame the next question with kind of an interesting comment. So our podcast has a very, very large global following of institutional retail investors as well as corporate issuers. So I think they're going to love this question. What is the options market signaling right now about market expectations for small caps?
Sure. Another good question. Options pricing contains a lot of useful information, including market expectations. So embedded into options pricing, which is essentially following a model, could be the Black-Scholes model. Embedded into the options pricing is implied volatility. And implied volatility is indicating levels of bullish or bearishness. Another approach is to look at the put-call ratio. Put-call ratio is the level of put buying, put trading, and call trading. When you see the put-call ratio at 1, it's relatively neutral, but when it's greater than 1, it's showing levels of bearishness. So right now we're seeing the put-call ratio in the Russell 2000 over 2, and we're seeing implied volatility on the Russell 2000 elevated. So the implied volatility and the put-call ratio is showing a somewhat bearish view, but it's very short term. It's 30 days or less.
Presumably that's tied to the recent rally in the small caps?
Well, I would say it's independent to that. Okay. And the reason why is, and this is something that we may touch on later, is the volatility index, which is looking at the volatility of the Russell 2000 across tenors. And so RVX is the ticker, similar to DIX on the S&P 500.
Sure.
And that's telling a slightly different story.
Okay. So if I think about macro sensitivity and event risk, with the Russell 2000 sensitivity to interest rates, are there specific events or Fed announcements where options positioning becomes particularly important?
So each year, FTSE Russell makes adjustments to their indexes. And in the past, it's been once a year. This year, they're going to do it twice a year. And this is when FTSE Russell looks at all the constituents within each of their indexes. So overall, they have a Russell 3000 that's looking at the market in total, and they segment between large cap and small cap. Russell 1000 representing the large cap, Russell 2000 the small cap. So there are constituents within these indexes that can go up or down, added or removed from these various indices. They have what they call a Russell reconstitution, which is a multi-week process. I'm not sure if it's 6 or 8 weeks, but it takes, multiple weeks to go through this reconstitution process. And they manage it in such a way so that the marketplace can digest how these indexes are going to be adjusted. it has the potential to be very influential on, let's say, index movement, because on the day that the index is reconstituted, it is the most actively, or has been, one of the most actively traded equity trading days of the year. So we've looked at the volatility on the Russell 2000 during the Russell recon period. And 75% of the time, roughly, the volatility levels are normal. So I think that creates an interesting opportunity. If the backdrop on the Russell 2000 is, you're not seeing that much movement in the volatility, it could be an interesting time to look at opportunities to harvest volatility by selling calls or selling puts or doing verticals where you're collecting premiums.
Okay. From a volatility lens perspective, let's revisit RVX that you just alluded to moments ago. So Cboe publishes the Cboe Russell 2000 Volatility Index, or also known as RVX, a VIX-style measure of 30-day expected volatility. Similar to realized volatility measures, RVX has historically been higher than the VIX index, reflecting the unique risk profile of small caps. What knowledge can investors gain from looking at RVX?
So I think it's important to define what is VIX. Cboe's VIX index measures the 30-day expected volatility on the S&P 500, and oftentimes viewed as a fear gauge because the index typically behaves inversely from the S&P 500. So as the S&P 500 goes up, VIX goes down and vice versa. Cboe has used the same methodology that's used to calculate VIX and applied it to the Russell 2000. So that index is referred to as RVX. It's an index. There's no tradable instrument on RVX at this moment. We used to have options and futures on RVX, but at this moment we don't. But the index is being calculated and prices are being disseminated. And for those who are interested in what is RVX indicating right now, well, RVX in the past, let's say in 2025, had a range of 45 to 18. And on average, it's around 24. Today, it's at 23.83, so it's neutral. But what makes RVX interesting is that it carries a premium to VIX, and usually that's around 5%. So it's an indication that for those market participants that are looking for opportunities to harvest volatility, the Russell 2000 can be very interesting. And there are strategies that I can name that may be foreign to your audience, like butterflies or condors, spreads that are used to typically harvest volatility and generate income.
So Cboe recently announced plans to expand RUT options to its global trading hours. What kind of demand are you seeing thus far from investors, especially international clients, for extended hours access to U.S. small cap exposure?
Thanks for asking. So Cboe has had SPX and VIX derivatives listed on our global trading hour session, which we call 24 by 5. And we're seeing demand from international retail brokers and institutional investors. And we're excited to include RUT onto the global trading hour session. And pending regulatory approvals, Cboe is planning to add RUT to global trading hours in February. We anticipate that we're going to see the same market participants, retail and institutions, that will want access to RUT options for market moving events, the ability to adjust positions and manage their risk on a real-time basis. And it doesn't necessarily have to be from offshore market participants. We may have some onshore prop traders or retail traders that want to take advantage of the overnight session as well.
Excellent. What are you watching as we think about the broader 2026 that's going to unfold that could be a catalyst for small cap options activity?
Sure. So Russell 2000 has been underperforming for many years, and now we're seeing its day, its moment in the light. That's because we're seeing a lot of interest in the domestic small caps, because of lower interest rates, earnings are going to be much stronger. Tariffs should lend itself to more domestic trading activity. And I think the small caps are going to be in favor. We've seen that with the rotation. But what has been driving a lot of the activity has been the retail trading activity, particularly in short-dated options. And what's interesting about that, it's not one-sided. We're seeing retail looking at expressing a long or short view in the market, as well as looking at opportunities to harvest volatility. So it's fairly balanced. We have a derivatives market intelligence team that produces analytics and papers on different types of topics. We're expecting Mandy Zhu's team to produce a paper shortly that's going to reflect trading activity in the Russell 2000 on a short-dated basis. And for those who are interested in that, come to Cboe's website. It should be posted sometime within the next few weeks.
Excellent. When that's ready, please send it to me and I'll make sure we put it up on our website as well for our listeners.
Sure. Thank you.
So just wrapping things up, is there one misconception about Russell 2000 options that you would like to clear up for podcast listeners here?
I think one of the greatest challenges that we have, Tim, as an industry, is overcoming the lack of options education. We have what we call our Options Institute, OI. It's celebrating its 40th anniversary, and it's focused on working with individuals, financial advisors, and institutional market participants, offering access to really good educational content. So understanding the benefits of using options-based strategies are important, whether you do it yourself or allocate to a 40 Act fund or outsource to an investment manager on an estimate basis. So I look at that, and it's not just RUT centric, it's overall.
Well, great. Rick, thanks so much for joining us today and for those very interesting insights into Russell 2000 options and the small cap derivatives market. Thank you for listening, and do not forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the WTR on the Horizon written research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules. We will see you next time for another edition of WTR on the Horizon podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.